Hi everybody, it's Clarke Camper with the June edition of Wall Street in Washington. Today I'd like to do something a little bit different. There hasn't been a ton of big activities on which to report during the last month. So what I want to do is talk about sort of an update on a series of items, but I will put them into four different categories. The first is the U.S. presidential election. Second is U.S. fiscal policy. Third is, it wouldn't be a Wall Street in Washington without a reference to Dodd-Frank Act derivatives. And finally, then I want to talk about some issues that I'll categorize as market regulation. First, on the presidential election, I've said all along, and I want to say it again, that this race is going to be very, very close. What I find sort of interesting is that earlier this year, everyone was convinced that President Obama was going to be reelected. You know, he had a lock on it, particularly in the wake of the difficult Republican primary season. Now then, over the past month, it seems that the tide has changed and everyone believes that we're going to have a President Romney next year. I thought it was best summed up by one Republican strategist I know who said something like, look, this is ridiculous. The media is acting like, 2 months ago the Obama people were incredibly smart and now they're all dumb. His point was, these are the same people. They're no smarter or dumber than they were before. And the fact is, again, this is going to be very, very tight through the election. If you enjoyed the political drama, the ups and downs, great, follow it. Otherwise, I'd turn off your TV set until maybe after Labor Day, and then let's see where the race is at that point. Second, in terms of U.S. fiscal policy, I've talked in the past about the Fiscal Cliff, or Taxmageddon, as some have called it. That's the combination of spending cuts and tax increases that would come into place January 1, 2013, if there is no action between now and then. I continue to be optimistic that Congress and the President will do something to forestall the effects of the fiscal cliff. I also continue to believe that that will happen after the election in November, when there'll be a short lame duck session. There are people who disagree with me and people that I respect who disagree with me and think that Congress and the President will not be able to come to an agreement and that this actually will kick into 2013. But again, my feeling is that these members there may be a level of partisanship that's extraordinary in Washington, but nobody is suicidal. I believe we're all going to hold hands one way or another and address that fiscal cliff. However, there are a couple issues that I want to mention in particular that the industry should be very focused on in the fiscal cliff discussion. Part of the addressing the fiscal cliff certainly will be looking for revenue raisers. One obvious revenue raiser is 60-40 tax treatment for derivatives. Doesn't raise a whole lot of money, about $3 billion over 10 years by most estimates. However, that also on the flip side makes it a very easy little sweetener when members and staff are sitting around the table late in the year trying to find a billion here, a billion there. It's easy to say, hey, we have $3 billion here. Now, why do I bring that to your attention now? It's because if you care about 60-40 tax treatment, and obviously many of us in the industry do, now is the time to begin making the case, articulating why it is important to maintain 60-40 tax treatment. Second issue that I want to mention in this category is transaction tax. I know people are tired of hearing me and others talk about it. I'm tired of talking about it. But as we have seen in Europe, a transaction tax of some sort seems to be in the cards in coming months, if not years. I think if Europe goes that direction, and depending upon a number of other political calculations in the U.S., the bottom line is that a transaction tax is very much at risk in the U.S. context, especially during a time that the Congress and the President are desperately looking for revenues. So again, if you care about that issue, now is the time to make the case to oppose the transaction tax. And by the way, NYSE Euronext is indeed leading a coalition in Washington to do just that. Third, I'd like to move to Dodd-Frank Derivatives Act rulemaking. There's been an interesting development, and that is that the SEC, since my last taping, released a time frame for their rulemaking implementing the Dodd-Frank Act provisions. And what surprised many is that under that time frame, the SEC is unlikely to actually implement any clearing mandates under Dodd-Frank until 2013. That's juxtaposed with the CFTC, which currently is on pace to actually institute at least some mandates on certain products, some clearing mandates on certain products by the end of 2012. So it's just an interesting divergence. Watch that space. I assume that one way or another there will be a convergence of the SEC and CFTC implementation, but at this point it's not clear how that will happen. Finally, I wanted to mention three things under the category of what I call market regulation. First, the Consolidated Audit Trail, or CAT. We continue to expect a proposal, or actually a final rule from the SEC on the CAT anytime now. I know the industry's been expecting this for months. I will tell you that behind the scenes, things have reached such a fever pitch that I actually do think it's going to happen in June or July. I do believe it also will not be real time, which has been a very important issue to the industry. Second issue I want to mention is limit up, limit down. It's well known that the SEC adopted the rule. It goes into effect next February, that is February 2013. One issue that remains outstanding is how it is applied in the options markets. Obviously a very important issue. So far there's not been clarification or guidance from the SEC. I do expect that prior to February 2013 there will be some form of guidance from the SEC. It may come late in the game, but I do believe that they realize it's a real problem and the SEC will act to address it. Finally, I want to mention market-wide circuit breakers. One issue has been, do the circuit breakers apply? And those two, as it's well known, were adopted by the SEC recently. But the question is, do they apply just in the securities markets or also in the derivatives markets? What I've heard behind the scenes is that CME is ready to accept a market-wide circuit breaker system in the derivatives markets. It probably will be different from that in the securities markets. It probably will be one rule that applies throughout the entire day. In other words, doesn't have specific different rules for opening and closing. But from what I'm hearing, and again, it's not official, but what I'm hearing behind the scenes is that CME has agreed to support market-wide circuit breakers in the derivatives space. So with that, I'll wrap things up. See you next month on Wall Street in Washington.